REG Area V tests how entities calculate taxable income, reconcile book-to-tax income, report separately stated items, track owner basis, and determine entity-level or owner-level tax consequences. The first step is identifying the entity type, because similar facts can produce different tax results for C corporations, S corporations, partnerships, LLCs, and tax-exempt organizations. And listen, for the CPA exam, you generally do not need to memorize exact indexed limits, phase-out thresholds, or specific current tax rates. The exam will provide those figures in the exhibits right when you need them. This area is a massive piece of your exam. We're talking 23 to 33% of the entire REG section. That's a huge chunk. To crush this part, you've got to master the differences between book and tax accounting, understand the operational mechanics of pass-through entities, know the specific rules for C corporations, and, perhaps most importantly, you have to be able to perform diagnostic reviews of entity tax returns, like Forms 1120, 1120S, and 1065. In a lot of these scenarios, you're basically acting as the final reviewer, hunting for hidden errors in the tax compliance process. Okay, so let's get right into it. To master Area V, you really need a rock-solid systematic approach. For every single simulation or multiple choice question you face, I want you to mentally run through exactly 8 core framework questions. Ready? First, what entity is involved? Second, is there an entity-level tax, or does the tax fall directly on the owners? Third, what exactly constitutes ordinary business income here? Fourth, what items must be separately stated on a K-1? Fifth, does this specific transaction change the owner's basis? Sixth, are the owner's losses limited by that basis? Seventh, is this distribution taxable? And finally, what return form or schedule is actually affected? If you can answer those 8 questions for any scenario they throw at you, you are gonna pass this section. Now, the absolute core of tax compliance often boils down to reconciling your book income to your taxable income, usually using Schedule M1 or M3. And to do that, you have to categorize adjustments as either permanent or temporary. Permanent differences literally never reverse. For example, if a corporation has $10,000 of municipal bond interest, it's sitting on the books as income forever, but it will never be taxed. You subtract it and you're done. The same logic applies to non-deductible penalties or the disallowed portion of business meals. You add those back permanently. Temporary differences, though, those are purely about timing. Say you use straight-line depreciation for your books, taking a $10,000 expense, but you use accelerated depreciation for tax, taking a $15,000 deduction. Well, you've got a temporary $5,000 difference. Your taxable income is lower right now, but it will absolutely reverse in future years when the tax depreciation runs out before the book depreciation does. Let's look at C corporations and see how this all builds. C corporations actually face an entity-level tax, and calculating their taxable income follows a very strict sequential flow. You start with gross income, then you subtract your ordinary and necessary business deductions. But, and this is key, you have to stop right there before taking any charitable contribution deduction. Why? Because charitable contributions are capped at 10% of the taxable income calculated before taking that very deduction and before the dividends received deduction. Speaking of the DRD, if our C corporation owns, say, a 15% stake in another domestic corporation and receives a $100,000 dividend, they don't pay tax on that whole amount. Since they own less than 20%, they get a 50% dividends received deduction. That means $50,000 is wiped right off their taxable income, which really helps mitigate the sting of triple taxation. Beyond standard deductions, you really need to nail down the corporate limitations. Take net operating losses, or NOLs. If a C corporation generates an NOL, it can carry that forward to offset future taxable income, though current rules usually cap that offset at 80% of taxable income. Capital losses, on the other hand, are treated completely differently. A C corporation cannot deduct a net capital loss against its ordinary income. Period. No exceptions. It can only be used to offset capital gains. Now, if they have allowable tax credits, remember that credits are basically gold. They reduce the actual tax liability dollar for dollar, unlike a deduction which just shrinks your taxable income. And finally, keep in mind the ultimate hallmark of a C corporation. When those post-tax profits are finally distributed to the shareholders as dividends, they get taxed all over again at the individual level. That's your classic double taxation right there. You're also going to be tested heavily on state and local tax, or SALT, issues for corporations. Remember, federal taxable income is literally just the starting point. State taxable income is often a totally different ballgame. The first concept to grasp is Nexus. Basically, does the corporation have enough economic presence or connection in a specific state for that state to legally demand tax? If Nexus does exist in multiple states, we use apportionment. This is how we divide up the active business operating income based on factors like property, payroll, and sales. It essentially slices the pie. Allocation, on the flip side, is for specific non-business income, like a dividend from a passive investment. That stuff doesn't get sliced up at all. It gets allocated 100% to a single state, which is usually the corporation's commercial domicile. Next up, we shift gears to S corporations. These are incredibly popular because they completely avoid that corporate double taxation by operating as pass-through entities. But to get this sweet tax treatment, the eligibility rules are incredibly strict. You can only have a maximum of 100 eligible shareholders, and generally, they have to be U.S. individuals, estates, or certain trusts. Absolutely no foreign corporations or non-resident aliens allowed. It has to be a domestic corporation, and it's only allowed one single class of stock. That means all shares have to have equal rights to distributions and liquidation proceeds. When an S-corp operates, it files an 1120-S, but it generally pays zero tax itself. Instead, its ordinary business income, along with all those separately stated items, flows straight through to the shareholders on a Schedule K-1. Now, for S corporations, you absolutely must understand the Accumulated Adjustments Account, or AAA. Think of the AAA like a protective bubble. It tracks the cumulative income the S corporation has earned that has already been taxed to the shareholders but just hasn't been distributed yet. Why does this even matter? Well, if an S corporation used to be a regular C corp, it might have leftover accumulated earnings and profits, or ENP, sitting around from those old C corp days. When the company makes a distribution, it comes out of that AAA bubble first, which is completely tax-free to the shareholder. But once that AAA drops to zero, any further distribution dips straight into that old ENP, which triggers a taxable dividend to the shareholder. Also, keep this in mind. If an S-corp has leftover ENP and generates way too much passive investment income, it actually risks losing its S election entirely. Tracking a shareholder's stock basis is absolutely critical. Why? Well, basis dictates if a distribution is tax-free, and it determines if a loss is actually deductible. Basis goes up when the shareholder contributes cash or property, and it increases with their share of ordinary business income, separately stated income, and, get this, even tax-exempt income. On the flip side, basis goes down for non-deductible expenses, ordinary losses, separately stated loss items, and distributions. Now, the absolute golden rule you need to drill into your head is that basis can never, ever drop below zero. Plus, you have to apply these rules in the exact right order. You increase basis for income first, then you take out your distributions, and only after that do you apply any losses. All right, here is a crucial, heavily tested point. How does debt affect basis? It's a tale of two entities. For an S corporation, a shareholder only gets debt basis if they personally and directly loan money to the S corp. A bank loan to the S corp does absolutely nothing for the shareholder's basis, even if they personally guarantee the loan. However, for a partnership, a partner's outside basis actually includes their allocated share of the partnership's overall entity-level liabilities. So if the partnership takes out a mortgage, the partner's basis go up. Do not mix these two rules up on exam day. Let's zoom in on partnership mechanics. Like S-corps, they're pass-through entities filing Form 1065. All ordinary income and separately stated items flow right through to the partner's K-1s. But a totally unique feature here is the guaranteed payment. Think of this essentially as a salary paid to a partner for services or capital, regardless of whether the partnership is actually profitable. The partnership gets to deduct this payment as an ordinary business expense, and the partner who receives it has to report it as ordinary income. And just like we discussed earlier, a partner's outside basis limits the amount of losses they can deduct on their personal return. That outside basis is constantly being adjusted by their contributions, their distributions, and, crucially, their share of partnership liabilities. Moving right along to LLCs and tax-exempt organizations. Listen, an LLC is just a legal structure recognized by the state. It is not a tax classification recognized by the IRS. By default, a single-member LLC is treated as a disregarded entity, while a multi-member LLC is treated as a partnership. However, an LLC can actually check a box and explicitly elect to be taxed as a C corporation, or, if they're eligible, an S corporation. Now, for tax-exempt organizations, the rule is they must operate exclusively for an exempt purpose, think charity or education, and they have to comply with incredibly strict annual filing requirements to maintain that status. The massive exam trap here is unrelated business income, or UBI. If an exempt organization runs a commercial business on the side that isn't substantially related to its core exempt purpose, that specific income gets taxed at regular corporate rates. Section 14, the simulation pivot, applying the framework to task-based simulations and source documents. Okay, so when you actually face a task-based simulation, you're usually acting as the reviewer. You are hunting for the disconnect between the source documents and the tax forms. If you're reviewing an adjusted book trial balance, check to see if the preparer just totally forgot to make an M1 or M3 adjustment for a permanent or temporary difference. If you're looking at a K1, make sure a separately stated item, like a charitable contribution, wasn't accidentally buried inside ordinary income. On a C Corp Form 1120, verify that they didn't illegally deduct a net capital loss against ordinary income, or maybe they botched the state apportionment calculation. For an 1120S, check if the preparer completely ignored the shareholder's direct loan when calculating debt basis, or if they messed up the AAA calculation. For a 1065, ensure partnership liabilities were correctly allocated to the partner's outside basis. And if you're looking at financials for an exempt org, you need to scour them for commercial activities that should definitely be taxed as unrelated business income. All right, let's do a rapid-fire breakdown of the absolute most common exam traps candidates fall into. Number 1, treating pass-throughs like C corporations. Remember, an S corp or partnership generally does not pay entity-level tax. Number 2, blending separately stated items into ordinary income. Things like capital gains or Section 179 deductions have to maintain their unique character. Number 3, taking a loss deduction on an individual return when the owner's basis is completely zero. You can't deduct what you don't have. Number 4, giving an S-corp shareholder basis for a bank loan. Remember, that trick only works in a partnership. Number 5, forgetting that state taxable income actually requires apportionment. Number 6, ignoring the AA balance when an S-corp has old C-corp ENP sitting around. Number 7, confusing book revenue with taxable income. And finally, number 8, assuming a tax-exempt organization pays zero tax on everything and totally forgetting about the UBI rules. Area 5 is an entity classification, book tax, basis, return review area. First, identify the entity, determine who pays tax, separate ordinary and separately stated items, reconcile book to tax income, track basis, apply law/distribution rules, review correct return.